Older homeowners may have a myriad of reasons for downsizing their home. It could be reducing expenses, moving closer to family or friends, or reducing required upkeep and maintenance. For some, it's an economic necessity triggered by medical expenses, surging homeowners' insurance premiums, or utility costs, says a recent Bankrate column. For others, it may be means of stretching their retirement dollars. Bankrate suggests homeowners looking to downsize in retirement to consider the following: when and where they plan to retire, their sources of income, current expenses, and what they'll need to purchase the new property and the mortgage. The financial benefit of downsizing in retirement typically results when going from a large mortgage to a small mortgage or from a small mortgage to no mortgage at all, says Greg McBride, Chief Financial Analyst for Bankrate. If you have substantial equity in your existing home, downsizing can mean taking that equity when the home is sold and using it to pay cash or make a large down payment on a lower priced property, reducing your monthly living expenses. Most homeowners that are looking to downsize in retirement are completely unaware that they may not even need to have another mortgage payment at all after investing some of the proceeds from the sale of their previous home. And this is the beauty of the Home Equity Conversion Mortgage Purchase, or H4P program. It's easy to downsize in terms of space, but downsizing in cost may not be simple, says McBride. If you've been in your current home for a long time, the smaller place you look to downsize to may be selling for more than you originally purchased your existing home. You don't want to go from a loan with a small mortgage to a larger one, or from no mortgage to now having a monthly mortgage payment. And that's true in retirement, but not to be overlooked are the costs that are associated with downsizing. Those expenses could be including the repairs on the existing home before sale, realtor commissions, closing costs, and even transfer fees in some states. Then there are buyer costs, such as attorney fees and title insurance when you purchase your new home, notes Bankrate. CBS MoneyWatch reports, though inflation is easing and the Federal Reserve's recent rate cut should help to ease the pressure on many Americans, some are still struggling financially. And that might mean turning to credit cards to help make ends meet, or for some homeowners, tapping into their home equity. For seniors, there are many ways to accomplish this, and the home equity line of credit and reverse mortgages are just two of the most common. Now, both let you borrow from the equity in your home over an extended period of time if you need to. But which one is best as you age and why? And here's what the experts have to say. Reverse mortgages can be a smart option if you have limited income and would have had a difficult time in making your monthly payment, says Rose Krieger, a senior home loan specialist at Churchill Mortgage. It varies based on what your long-term plan is for the house, says Jay Zigmont, a certified financial planner and founder of Child Free Wealth. With a reverse mortgage, it needs to be paid off before the house can be transferred to someone else. If you are single and don't care about the house after you pass, a reverse mortgage may allow you to get more out of it than a HELOC. CBS MoneyWatch notes that if you can swing the monthly payments, a HELOC could be a better option and would likely save you money. And that's because reverse mortgages, they say, typically come with high fees, while a HELOC, or home equity line of credit, may have none or very few fees. Now, a HELOC could also be a better choice if you're planning to use the funds for home improvement, and that may qualify you for a valuable tax deduction and allow you to write off the interest that you pay on your HELOC each year. Now, with reverse mortgages, they add, you're typically rolling your interest payments into a future loan balance, so the deduction is not possible at that time. What does Ginnie Mae's acting president have to say about the HECM Mortgage-Backed Securities Program, or the HMBS? Before we address that, let's first examine how mortgage-backed securities work, because the secondary market is the economic engine behind the FHA home equity conversion mortgage. Now, Ginnie Mae's HECM mortgage-backed securities, or the HMBS, begins when approved lenders originate a HECM loan. Now, those loans are then eventually pooled into mortgage-backed securities, which are guaranteed by Ginnie Mae. Ginnie then resells the securities on the secondary market to institutional investors, which are commonly pension funds, insurance companies, or hedge funds, who then receive timely payments. Housing Wire's Chris Klaus sat down with Ginnie Mae's acting president, Sam Valverde, and he discussed taking over the reins from the former president, Alana McCargo, among other things. HMBS is a small part of our portfolio, but it's a critically important part of how we meet our mission. Ensuring this critical retirement tool remains available to America's seniors is just not Ginnie Mae's priority, it's a shared priority between us, the Federal Housing Administration, or FHA, the U.S. Department of Housing and Urban Development, and broadly our industry partners. Valverde spoke to the importance of the HECM and Ginnie Mae's mortgage-backed securities, saying, "I think the growing demographic need for this program suggests there's new demand on the horizon that can support the future growth of the program if we can stabilize it in the near term." Now, part of that stabilization is easing liquidity strains on lenders who issue HECM mortgage-backed securities. That issue came to the forefront with the collapse of the former reverse mortgage lender, RMF, or reverse mortgage funding, in 2022. Now, that led to the agency, Ginnie Mae, to begin to develop what is now called HMBS 2.0. We began exploring a new securities program, what we in the industry have been calling HMBS 2.0. For that, we've consulted closely with issuers and industry experts to identify the needs of the market and get their input. Ginnie Mae issued preliminary terms for the HMBS 2.0 program this summer, soliciting public comment. And the program would give issuing lenders more time to finance the buyout of a HECM from the securities pool when required, and that would help ease liquidity strains on lenders. Now, you can follow Housing Wire and HECMWorld.com for future developments in the HMBS 2.0 program. Thank you for joining us for this week's episode of HECM World Weekly. We do have an audio companion to this podcast. If you can't sit down and watch, you can always listen when you're on your commute to work or running errands. You can find that on Apple Music, Spotify, and on Podbean.com. Thank you so much for joining us, and be sure to come back next week for more reverse mortgage news you'll only find here at HECM World. Have a great week.